and welcome to this August 23rd, 2010 video version of Invested Central's Chart of the Day. I'm Tom Boley, Invested Central's Chief Market Strategist, and it's my pleasure to provide you today's Chart of the Day. This Chart of the Day is brought to you by StockCharts.com, simply the web's best financial charts. Before I get into this chart, I do want to mention to everyone that this recording is taking place as of Thursday evening, August 19th, so it does not include Friday's trading activity. So we'll have to look at that and update it and see if we get some sort of breakout based on Friday's activity. But basically what this is a chart that shows the ratio of the consumer staples sector relative to the consumer discretionary sector. And the reason that this is important, it's one of the market messages that we look at to determine the sustainability of a move to the upside. Whenever the market is in a good mood and uptrending, we want to see certain things take place in the market. One thing that is common amongst almost all bull markets is that investors are willing to take on more risk. And when you look at the XLP, which is the consumer staples ETF, and compare it to the XLY, which is the consumer discretionary ETF, this ratio really, in a sense, gives you a way of evaluating the risk that investors are willing to take in the market. Let me just expand on that for a minute. The XLP, or consumer staple stocks, are stocks like toothpaste. These are things that you need. It doesn't matter what economy you're in, whether things are great, whether things are horrible, chances are you're still going to go out and you're going to buy your toothpaste when you need it. The XLY, though, represents consumer discretionary stocks. These are the types of things that people buy when they're in a good mood. They've got a nice job, they just got a raise. When you get that kind of more of a euphoric type mood in the market, you see investors start to flock towards consumer discretionary. These include, car purchases, car companies. It includes home builders. If folks want to go out and buy houses, that's all included in the consumer discretionary group. Going out and buying additional clothes and so forth. These are things that you don't necessarily need, but they're things that you want. And that's the distinction between the XLP and the XLY. Is the XLP, when money is flowing towards the XLP and this ratio is moving higher, it's showing that investors don't have the appetite for that additional risk that's associated with consumer discretionary. Instead, they play it close to the vest and they stick with the types of stocks that produce things that people need as opposed to things that people want. So when you're looking at the market going higher and you've got the XLP versus the XLY also going higher, it doesn't make a lot of sense, because in essence it's the market moving up even though investors are unwilling to take that additional risk on that's necessary by moving into XLY. Now take, for instance, just look at the last couple of months, because this is really important. Back in April, you can see when the market was moving up and we hit that high in April, notice how this ratio was down near its low, or at its low, in late April. But since then, we've been moving higher, which is indicative of a weakening market. But notice that back just a little bit ago, the S&P 500 a couple weeks ago, trying to break above the 1131 level. So it's trying to break out at a time when we're starting to see investors kind of moving more into a shell. And that's where I think this chart really comes in handy, because we've got a market that's trying to push higher, or that was trying to push higher, at a time when investors were not willing to take the risk to further that advance. And that's the key here. I hope you've enjoyed our presentation today. Be sure to check out our chart of the day every day at InvestedCentral.com. While you're there, sign up for our free weekly Market Pulse newsletter and have the chart of the day emailed directly to you. Happy trading.